So, first off, from Donna, it says, would like to address buying gold and options versus government bonds that are tanking. All right. So this one did come in ahead of time. So let me go back and share my screen because it's a chart that I actually pull up quite a bit when it comes to, people talk about that because they ask this question and then I get it. There is, I plotted some ETFs, pretty simple. Gold shares where you're actually, this ETF owns gold bullion. So it's a good proxy of what's happened to an investment in gold. I then plotted treasury bonds. This is the GOVT ETF, which is a blend of all the issues of government bonds out there. And then I wanted to remind people of, and I mentioned that SCM will buy high yield bonds. We don't ever buy and hold them, but those are considered junk bonds. And what fascinates me is over more longer periods of times, these bonds that tend to be more risky in the junk bond market have outperformed significantly treasury bonds, which are considered low risk, which, by the way, the only way treasury bonds are considered low risk is if you buy them when they're issued and you hold them till maturity. In between them, they're going to fluctuate in prices. So as interest rates go up, say you bought a bond at 2% and interest rates are now 4%, you're going to have to get a discount if you want to sell that. So that's why they go down in price. So looking at that, the gold line is the gold ETF. And you could see a really tough start the last 10 years, and then it's kind of climbed its way back up. But an investment going back to 2012, equal investment in gold and treasury bonds, which definitely have tanked, has paid the same returns. So that's something to keep in mind. Yes, gold's been doing better. Yes, bonds have been tanking. But over the long term, they've been doing well. But look at high yield bonds. By the way, this is an apples to oranges to grapes comparison because they're completely different vehicles. But if you want to say, why would I own treasury bonds? Why wouldn't I own gold? I would argue, have you looked at other bond classes? Because not all bond classes are getting hit the same. In fact, it's been fascinating to see high yield bonds, which are considered junk bonds, outperforming the last few months treasury bonds, which are considered low risk. So all of that is to say they're not a fair comparison. Somebody that would normally invest in treasury bonds should probably not invest in high yield bonds, and especially should not invest in gold. If you look at the returns, over time, 15-year returns, gold has been slightly better than junk bonds. It's certainly been better there, but there's times where gold has lost money. And what's more important is the ride. This is the drawdown percentage. So you could lose 40% in gold. You lost, close to 20% in 2022 in gold. It certainly has recovered. But again, what's blown me away is how junk bonds have outperformed both of them. So hopefully that answered your question. Again, it's apples to oranges to grapes, not even the same investments. So it shouldn't really be a trade-off there. We'll talk at the end of the year about bond investments and the outlook there. The other thing, early in my career, Art Cashin, he's the floor director of UBS. He's been trading, I think he started in the 1940s as a teenager working on Wall Street. And he was asked one time, how much gold should I have in the portfolio? And a veteran of Wall Street told him, enough to bribe the border guards. And we might laugh about that, but his idea was, and I believe it firmly holds today, is, and I posted a blog about this, every other developed country is in way more dire straits than the US is. Our government is, I've heard it described, the best looking horse in the glue factory, but our demographics, our level of debt, our growth is so much better than Europe, Japan, China. Every other developed country is way worse off than we are. So I'm not saying this is a good time to buy treasury bonds. What I'm saying is, is if your reason for buying gold is you're afraid of the US government failing, you're probably going to be disappointed. Because over the long term, gold's just designed to match the level of inflation. And I get it, we're concerned about inflation right now, but we'll talk about this in November. Long term, I'm more concerned about deflation than inflation, which means gold could be a losing battle. And so Art's reasoning for saying you just need enough gold to bribe the border guards is, if we get to the point where dollars are worthless, not worth less, but worthless, it's going to be complete anarchy. There is not enough paper currency anywhere in the world to support the standard of living that developed countries have. And so we're going to be on a barter system. It's not going to be a area where gold is going to do you much good unless you also invested in a bunker, guns, and ammunition and food, because the price of a loaf of bread will be however much gold you have. That's the dire thing that I don't even think is in the realm of possibilities. But again, because demographically, our country is way better off than every other country in the world there. So hopefully that answered your question, Donna. Let's look at the next one. Okay. Buy low and sell high, enhance somehow. Are you guys the best all of the time, most of the time, some of the time, or not? That's a really good question. The short answer is we're definitely not the best all the time. There's times where our version will do much better than everybody else, and there's going to be times where it doesn't do as good as everybody else, and it depends on the market cycle. But it's also going to depend on which investment model you're in. So I kind of wanted to walk through sorry, I apparently can't do two things at once. Let me share my screen again, if Zoom will let me. All right, well, it's not letting me share. So, oh, there we go. I found my doc. So let me go back and find that slide here. The first thing to understand is this dotted line there are passive, no fee, buy and hold portfolios put together by a very popular mutual fund company who says you shouldn't pay fees. And this is the modeled risk on the bottom and the returns on the upside. So in general, we have to understand that the longer you hold, the more risk you can take, and also the higher returns you should expect. Or flip that and say, the more you want to return, the more risk you're going to have to take. And you can see on a model basis, when you're out here trying to match the stock market, we're going to be about the same returns and about the same risk. But as your goal is to take less risk, SEM would tend to be better long-term because of our active approach. And, buy low, sell high is something that is easy to say, but very difficult to do. We have a few models that try to do it, but we more care about the trends. If you look out here, and obviously last year was a good example, I almost need to adjust these charts because bonds lost so much money last year. They're actually negative on a buy and hold basis on returns. If you had the aggregate bond index for the last 10 years, you've lost money, and you risked about 20%. But anyways, let's consider that was abnormal, and we're going to revert back to what we had. Where SEM adds the most value is on the fixed income side. And one way that we do that is buying and selling high yield bonds. And so with high yield bonds, and this is an example of what we're trying to do, is you could see here we sold, and we would have bought back in on this model at a lower price. But there's times if the market, we might sell and then have to get back in at a higher price. What we're trying to do is avoid the really large drops. For instance, in 2022, when we sold, the bond market actually rallied and then it tanked. And then it rallied a little bit and then it tanked again. And by the time we got in, we were way better off. So I will put our track record, which is all real time, going back into the 90s against what other people have done on fixed income. What becomes a little bit harder is when you're dealing with the stock market. And we have Amerigard and Cornerstone models that are, their goal is to be in the market as much as possible, but they have trend indicators. And this is a very busy chart. I put it at the bottom of our blog every week, just, you know, for people to look at and consider. But the red is every time we sold and the green is every time we bought. And you see, there's a lot of times where you say, why in the world did you even bother? But even in 2022, you could see we sold here and we bought back at a lower level. And you go back to 2008, sold there, bought at a lower level. On both these models, they tend to do a really good job of missing the big drops. But when the drop doesn't materialize, we might have to get in at a higher price. So the short answer to your question is, the lower risk you want to take, the better we've been at navigating that by trying to buy low and sell high. The more you want return wise, the harder it has been. We've added value by reducing risk, but it is much harder with that. So hopefully that answered Michael's question. The next one is pretty simple. We've touched on it a little bit, and I'll in fact just go back to the chart, which is, how do investment strategies change with the age of the investor? And that comes from Gene. And obviously that's going to depend on the financial plan, Gene, but what we found is, again, going back to what I call our bubble slide or the bucket slide, is you end up, if you have a really long time horizon, we're going to want to be mostly invested in the stock market. As your time horizon for that bucket of money gets lower, you're going to want lower risk and a different investment strategy. If you're needing that money in 0 to 3 years, you're not wanting to take much risk at all. And then even 3 to 5 years, you don't want to take much risk, because as we saw, even bonds can lose a lot of money, and then you're not going to be able to make that back up in that short amount of time. And so it definitely is going to change. But keep in mind, you might be 80 years old and say, this money is literally for my kids and grandkids to inherit. We can take a whole lot of risk because that's long-term money. Or you might be just retiring, but we're not going to touch your IRA until 25 years from now. That's still long-term money. So this is why it's so critical to understand your financial plan. Is it's not just, hey, I'm older, therefore I have less risk and a different investment strategy. It comes down to, what is the purpose of the money and where does it fit in your financial plan? So hopefully, Gene, that answered your question. We got a little bit more time here, so if you have any more, keep them coming. How could the UAW strike impact our economy? I'm actually getting ready to do a video on social media on that. I try to not play politics. If any of you have heard my presentations before, I'm a registered independent, and I have been since 2008. So I always tell people I'm going to probably offend both sides equally. Overall, what just frustrates the heck out of me is we were finally getting momentum on the manufacturing side. And I know I said I'd wait till November to talk about our trade deficit, but we're literally whittling into our trade deficit. I showed you how we're importing so much less that it's boosting GDP, because we're now actually exporting more than we're importing. And the auto industry here in the US has, you know, it's always been dealing with competitors, you know, who are either not union or they make their cars elsewhere, who don't have minimum wage, who don't pay benefits, who, you know, don't care where they get their supply chain. And the Inflation Reduction Act, long term, could potentially reduce inflation because it's supposed to put more people to work and make them more productive. But there were some things built in that were already going to be inflationary, which includes having to source a lot of our batteries and build a lot of our cars here in the US and make them electric, that's going to add to inflation. So that's long-term a bad deal, because I mean, who are we kidding? If car manufacturers which I think Ford of the three, this is not stock recommendation, it's just, you know, my old accounting background. Ford by far is the best run of the big three. I looked at them, they have a 3.5% net profit margin. There's not a lot of room to raise wages by 40%. And so then the UAW says, well, you should take it from executive compensation. So I ran the numbers, and there's $79 million of executive compensation at Ford. 21 million of that goes to their CEO. The rest is divvied up among everybody else. A lot of that's stock options, but let's just call it 79 million. If you divide that out by every single Ford employee that's part of UAW, guess what? They would get $459 extra per year if they just took all the executive compensation and paid that. So therefore, do we think Ford's going to become a nonprofit and go down to 0% profits? Or are they going to pass on a 40% pay raise and higher benefits and a 32-hour work week to the end customer? That's inflationary. I'm sorry, that's inflationary. Short term, the longer this goes on, I stick to the Wall Street estimates because we're not industry experts. If this goes on for another month, it's going to start whittling off about 0.5% from GDP growth rates. Ballpark, we were looking at 2 to 2.5% rates, so we could be down to 2%. So it's not going to throw us into a recession, but my big concern is it's going to be very inflationary if they get what they want, because US cars are going to be much more expensive. And so hopefully that answered that question. Looking at the next one from James, I think I touched on it. It says, how do you feel about gold as a hedge against US currency devaluation? I didn't have time to get the chart on this. Bloomberg had one out just a week ago. If you're a Bloomberg.com subscriber, if not, I'll try to find it and post it on the blog. But ironically, you know, we haven't had a true devaluation. And again, I feel like I touched on the fact that demographically, the US is so much better off that we're still going to be the reserve currency for a very, very long time. Go back a couple of weeks ago, I think I called it the China virus, maybe it was a little bit spicy, but there's a blog just a couple of weeks ago at scmwealth.com /traders blog talking about China. They are rolling over. There is zero chance that China will be able to become the reserve currency. The only economy in the world that's growing rapidly is India, and they have so much corruption that they're not going, it's not like we're going to use India's currency as a reserve currency. So our status as a reserve currency, if somebody wants to do business globally, it's going to have to be with the US dollar. But all that said, on a short-term basis, gold as a hedge against the devaluation of the dollar, it works okay at times, but the dollar lately has been ramping up a lot. And that's because the rest of the world is heading towards a recession much faster than the US is heading towards a recession. And therefore, people are buying dollars and wanting to hold on to dollars all across the developed world. So again, I'll go back to Art Cashin's advice is, if you're really concerned about your dollars becoming worth less, go, buy enough to get across the border, whatever gold coins make you feel safe. Also make sure you have guns and ammunition, have a way to keep it safe in your home. Certainly don't tell people that. If you're really concerned about that, you probably don't want it in a bank because, as we learned in the 1930s, the government can confiscate gold if they need to. But I don't think we're going there. The other thing, this gets a little bit too wonky, but for the most part at SCM, in fact, right now we're 100% invested in the US. We sold our last international position in 2017 in Ameriguard. At the beginning of this year, it added a 10% position back into international stocks. We actually just sold that in August. So we're back into US. So we don't have any currency exposure. So you, as a US citizen, if you're not investing internationally and you're not planning on going overseas, you really don't have to worry about currency devaluation. The only people who need to worry about is if you're not a US citizen and you own a bunch of dollars or you're planning on going overseas. Because like I said, we manage here at SCM the exposure based on what countries we want to be in. So that is all I have to say about that. I don't see any more questions. If any do come up, send us an email. We will post them. I always welcome everybody's feedback here. A lot of times questions from our clients and advisors and even people on social media turn into a blog or a video post. So definitely follow our pages on the different social media channels. I know it's a very, very difficult time just to be an American, especially those of us, in the middle class with conservative values, things like that. We are heading into an election season. It seems like every 4 years, I say this sooner and sooner. The one piece of advice I'll give you until we get to our next SCM University in November, and it's a piece of advice I've used since, I believe it was 2004 when I first said it, is do not let your ideological beliefs, your political opinions, influence your investment decisions. And I'm not taking lightly your political opinions, but again, just like it takes 9 to 12 months for one change in interest rates to filter through an economy, a president and a Congress can have very little impact short term. And it's very difficult to change a $21 or $22 trillion economy with just a few strokes of the pen. So please don't let that, whatever your opinions are politically and whatever's happening politically, change your investment decisions. At SCM, we're here to watch the trends, take money off the table as the data says is necessary. No opinions necessary here. I hope that's come across over and over and over again as my opinion, Rick's opinion, Cody's, Dustin's, everybody on our investment team. Our opinions don't matter when it comes to investing. All that matters in terms of what we look at is what the models say to do, what the data says to do, but more importantly, all that matters is what does your financial plan say you should be invested in? And that's what we try to do. So thank you again for joining us.